Hey there, crypto enthusiasts! Welcome back to our channel, where we break down complex financial concepts into bite-sized pieces you can easily digest. If you've ever dabbled in decentralized finance, you've probably heard the term automated market maker or AMM floating around. But what exactly is an AMM? How does it work, and why is it essential in the world of cryptocurrency? Well, you're in the right place. Today, we're diving deep into the world of AMMs, breaking it down so you can understand how they help shape the future of trading. So, let's get started. But first, let me ask you this. What if I told you that you could trade assets without a traditional order book or a centralized exchange? Sounds intriguing, right? That's precisely what automated market makers allow you to do. Let's explore how they work. To understand AMMs, we first need to grasp how traditional exchanges operate. In a centralized exchange, buyers and sellers place orders in an order book. When someone wants to buy an asset, they look for a seller at the same price, and vice versa. This system relies on liquidity providers, those who supply the assets to the market. However, these centralized exchanges can be slow, expensive, and sometimes even prone to manipulation. Enter the decentralized exchange, or DEX, which is where AMMs come into play. Instead of relying on an order book, AMMs use algorithms to enable trading directly from a liquidity pool. This is a smart and efficient way of matching buyers and sellers without needing a centralized entity. So, how does this liquidity pool function? Well, a liquidity pool is a collection of funds locked in a smart contract. Users, known as liquidity providers, deposit pairs of tokens into these pools. For example, you might deposit Ethereum and USDC into a pool. In return for providing liquidity, you earn a share of the trading fees generated by the trades that occur in that pool. This incentivizes users to keep their assets in the pool, which maintains liquidity essential for smooth trading. Let's take a look at a popular AMM, Uniswap. Launched in 2018, Uniswap allows anyone to create and participate in trading pools. Users can swap tokens directly using the liquidity in the pools, and the prices are determined by a formula known as the constant product formula, which is represented as X times Y equals K. Here, X and Y are the quantities of the two tokens, and K is a constant. This formula ensures that the product of the quantities remains the same, adjusting prices automatically based on supply and demand. For instance, if more users want to buy Ethereum from the pool, the amount of Ethereum decreases, causing its price to increase relative to USDC. Conversely, if users are selling Ethereum, its price will drop. This mechanism is what keeps the market efficient and functioning without manual intervention. Now, while AMMs provide a revolutionary way to trade assets, they're not without risks. One major concern is impermanent loss. This occurs when the price of tokens in the pool diverges significantly from their prices outside the pool. For example, if you deposit Ethereum and USDC into a liquidity pool and the price of Ethereum skyrockets, your holdings may be worth less than if you had just held onto your Ethereum. This loss is termed impermanent because if the prices return to their original state, you could recover your value. Additionally, there's also the risk of smart contract vulnerabilities. Since AMMs are governed by smart contracts, any bugs or exploits in the code can lead to significant financial losses. This is why it's crucial to do your research before investing in any AMM or liquidity pool. As we look towards the future, AMMs are evolving. New protocols are being developed to enhance efficiency, reduce risks, and expand the range of assets that can be traded. Innovations like concentrated liquidity allow liquidity providers to allocate their funds more efficiently, leading to better prices and reduced slippage for traders. This is just the beginning of how AMMs can transform trading in DeFi. To wrap things up, automated market makers are a game changer in the world of decentralized finance. By allowing users to trade without a centralized authority and providing liquidity through innovative pools, AMMs have opened up new avenues for trading and investing. Just remember to be aware of the risks involved, such as impermanent loss and smart contract vulnerabilities, before diving in. If you found this video helpful, give it a thumbs up, subscribe to our channel for more insights into the world of cryptocurrency, and hit that notification bell so you never miss an update. And hey, if you have any questions or topics you'd like us to cover next, drop them in the comments below. Thanks for watching, and happy trading!